in to this webinar, a Pantheon Macroeconomics webinar on the Eurozone economy. I realize it's kind of like the summer holidays or just at the beginning of them, but actually there's plenty to talk about. It seems to me that the political pieces in the Eurozone are kind of falling into play, they're kind of adding up now. I mean, we have the Lagarde at the ECB, and we have the new Commission president as well. So I'll discuss those two appointments a little bit insofar as they affect the economy. And then, of course, we have the ECB meeting next week, where I think they'll make some changes to the forward guidance as well. So actually, I think this is, there are some inflection points ahead at the moment in the EU as a whole and in the Eurozone economy. So let's just get started. You should have the presentations. As always, this event is going to be recorded, so you can go back and review it and listen to it if you want. You can ask questions, which I'll get to at the end of the presentation. If I don't get to them, I'm happy to have follow-up calls or afterwards. Alternatively, if you have questions, you can always just pick them up after the presentation later today or tomorrow. So we'll get through, I'm sure. Anyway, so I'm going to start with the economy. I just updated my outlook for which includes the 2021 forecast. I'll talk a little bit about that. But in general, if you look at leading indicators in the Eurozone economy, which can be split between the survey data, which is short leading indicators, as you see on slide number 1, and the slightly longer leading indicators, which is, the best one we have is real narrow money growth. They are now broadly telling the same story, which is that following a slowdown that began at the beginning of 2018, growth is now stabilizing at around 1 to 1.2% year over year, which translates into quarter-on-quarter growth of about 0.3%. We then have to split up the major economies because it seems to me that, or it's pretty clear that the Italian and German economies are still on the ropes. They're still doing quite poorly, whereas actually the French and the Spanish economies are doing better. So that's the headline story, and I think that's now also reflected in the consensus. If you look at the consensus forecast, they're now pretty much locked in at full year growth of the Eurozone at about 1 to 1.2%, which implies exactly what I just said, namely that you have a quarter-on-quarter rate of about 0.3. And you also have very low full-year growth rates built into consensus forecast for Italy and Germany, which is in part because of weak carryover effect from slow growth last year, but that's all in the surveys now. I think the Commission has Italy at 0 for the year and Germany at 0.5, which is really poor, but it's in the prices in the consensus, so we don't have to talk about that much, I think, even though it's very poor. If we then look a little bit into the details, I think, and this is what the leading indicators, or at least in the short run, don't really convey. Then you have the situation that in the first half of the year, Q1 was quite strong, but Q2 was probably really, really poor. So if you move over to slide number 3, then you can see what effectively is the the infamous GDP tracking models for the Eurozone. Now, if you split up those data, it really does suggest that the Q2 GDP headline is going to be quite poor, especially because of weakness in Italy and Germany. So as far as I can see, everything went wrong for the Eurozone economy in the second quarter. Industrial production slowed from a strong start to the year. Construction hit a brick wall. Consumer spending probably also slowed because spending on goods, which is reflected in the retail sales number, also slowed. And then really that only leaves us with services output, which was probably still okay, but still a little bit weaker than Q1. So I think that the data that are coming through at the moment are going to remain poor. In some sense, it's already in the data now. I mean, we have May data, we have April and May data, and they've already been really poor. But it's just to say that because we're always operating with kind of like a quarter lag, in the sense that as we go into Q3, where we are now, we're getting all the hard data for Q2, and I think that's going to be they're going to be poor. Normally, I wouldn't pay too much attention to that, except to note it. But at the moment, I think it does mean that it is significant, because those are the data, more or less, that the ECB will be looking at next week, but also in September, when it makes its decision of whether to ease or not, which is why I think that further monetary easing in the Eurozone is more or less locked in now. As we look forward to the second half of the year, I think the underlying trend in growth, this is what I just said about with respect to leading indicators, I think that's pretty strong, or well, not strong, but decent, about 0.3%. I mean, in some sense, I think now the Eurozone, the economy in the Eurozone is now at a place where, if you look at where the consensus is, and if you look at where the data is, I would say that 0.3% quote unquote is baseline. That's, nobody will bat an eyelid if that happens. 0.4%, perhaps even 0.5%, that would be really good. That would be an upside surprise, and the market would react to it as such. And 0.1 to 0.2% would be a downside surprise, and the market would react to it as such. I think the Q2 headline is going to be exactly that, a downside surprise based on that baseline. And in that sense, I think that's going to push the ECB over the line. So normally, as I said, the fact that we can say at this point that Q2 was poor, it doesn't really tell us that much from a forward-looking perspective. But I do actually think that carries over into what the ECB is going to be telling markets next week, and also in the September meeting, when we get the new staff projections, of course, which is going to reflect the fact that growth probably slowed in the second quarter. If you look across sectors, the story in the Eurozone is pretty much the same as it is in the global economy as a whole. I mean, you have a manufacturing sector which is in recession. If you look at slide number 4, you can see manufacturing is pretty much zero in terms of growth rate year over year, and this is value-added data, but you could look at production as well. Whereas the services sector has slowed, but is still looking all right. So the question I often get in this context is that, is there an argument to be made that the manufacturing sector leads the economy as a whole into recession? And yeah, there is. I mean, this is a fairly standard argument, especially in a context of a highly open economy such as the Eurozone, is that you get a hit to the export-sensitive sectors, such as manufacturing, and that then, with a lag, leads into a slowdown in the economy as a whole, and perhaps a technical recession. The problem is we don't have a lot of samples to choose from. If you look at this chart, for example, the only thing we can say is that this is what happened in 2002, 2003, which was a sort of, historically speaking, a relatively mild recession, namely that in this case, manufacturing rolled over first, then services rolled over about 4 quarters later, and you ended up with a mild recession. So it's certainly possible that we're staring at something similar here, except that the policy backdrop in this occasion is much, much more benign. And of course, it's really difficult to compare the current environment with what we saw in 2008 and 2012, which were, I mean, for all intended purposes, broad-based crisis in the Eurozone economy as a whole. So we have to be careful extrapolating based on what happened there. I mean, when I look at the data at the moment, it seems to me that the services data are stabilizing. I'll get back into that as I dig into the detail, whereas manufacturing still looks quite weak. And that fits the overall story, which is something like, if you were asking an economist, well, you could ask me or anyone else, but if you're asking an economist to gauge the recession risk in the Eurozone, I would imagine that economists would basically split the story down in two. You can have kind of two sources of risk, right? You can have the tightening in domestic financial conditions and tightening in external conditions. And normally, the Eurozone suffers a recession only if these two things coincide. At the moment, we have one of the two, namely an external shock. Global growth has slowed. Global external uncertainty has increased a lot. You have the global trade wars. You have Brexit. These are certainly headwinds. You also have the slowdown in Turkey, actually, which has hit aggregate exports quite a lot in the Eurozone. But domestically, you have an extremely accommodative backdrop, which probably is going to become more accommodative. Again, it seems to me that, I mean, fiscal policy is a super tank in the Eurozone, but it's probably getting looser, not tighter. And monetary policy is certainly going to get looser, I think, and in any case going to stay loose. So if you look at the sources of downside risk to the Eurozone at the moment, it's basically manufacturing, but also investment. I mean, if you look at the next slide on number 5, you can see that construction has generally held up well, whereas manufacturing has slowed. However, as we move forward, I think that's now changing. The construction data that came out today were horrible, and mainly horrible because the April numbers were revised down, and they were revised down because of a slowdown in Germany. So the thing about construction is that construction can be in an expansion, general expansion. This is to say, the level is going up, but underneath that can be huge amount of volatility. And I think we're now heading into a gully, mainly because of Germany. So if you look at this chart, you can see that the construction sector is rolling over. It's rolling over consistent with the expectations on the IFO rolling over, and I think this slowdown continues, which means that I think construction production in Germany in Q2 and Q3 will be very poor, and then we're going to see a pickup at the end of the year, coupled with what I also think is going to be a slowdown in manufacturing. I think the main downside risk in the next couple of quarters, which includes, by the way, which includes the whole gross picture, I'd say, and that includes also the second quarter. That's mainly investment, but there's an important detail here, and that the important detail is that if you split the gross and net capex data in the Eurozone, but this is to say, if you extract inventories, you can see that inventories have already been a huge drag on growth in the Eurozone. So the inventory correction started at some point in Q3, I would imagine, but it really hit the data in Q4 and then again in Q1. And in some economies, especially in an economy like Italy, I mean, if you pull up that chart on Italian inventories, I mean, that's basically, we have to go back to 2008 to find something similar. So it's possible that the gross capex data will stabilize a little bit because that inventory drag is now fading. But I think then the net investment data is going to roll over because the net investment data have been quite strong. So on net, I think investment is going to roll over here. But it's just to say that there's going to be a lot of pull and pull, a lot of drag and pull here between the gross and net capex data. And because we don't get that data on a timely basis, which effectively means we have to wait quite a long time before we see what's going on, it can be a little bit difficult to get a clear picture. But I think net investment is probably slowing, but the gross capex picture maybe is going to look a little bit better. Then we move on to the consumer. And I mean, the chart I've taken for the consumer here in this presentation effectively is one where I try to show what has gone wrong for the consumer in a context where actually fundamentals for the consumer is still quite good. So the level of sentiment is still quite high. Real wage growth is picking up this year because headline inflation is going down, but the savings rate has increased a lot. I don't think the savings rate is going to increase at this rate, at the same rate it did last year. And this is because, as you can see from this chart, is that household assets in the Eurozone are still growing at about 4%. This is a really, really important point because I don't think it's a point that's emphasized enough in the Eurozone. About 70 to 80% of household assets in the Eurozone is housing and deposits, and they're doing fine. House prices are now increasing. So if you look at the net worth of households, such as it is defined by the ECB, that's pretty much growing in line with nominal GDP. So, and because consumers are not taking on debt to the same extent as they did in previous upturns, the net asset position of consumers is improving. So there's really no reason for the savings rate to continue to increase at this rate, unless, and this is where the forecast element comes in, unless you assume that consumers are going to remain very, very afraid of external uncertainty, which is probably why that why the savings rate has increased in the first place. But I'm betting that the savings rate is basically going to flatten out, which means that it's not going to increase in the same rate, which then allows consumer spending to accelerate to, I mean, I'm actually quite conservative in my initial forecasts here for the rest of the year and into next year at about 1.5, but it could go much higher. I mean, real wage growth in the Eurozone, depending on which economy you look at, but broad-based is about 2, a little bit above that. So there's room to spend, and I don't think that is going to change. And to cap that picture in terms of the domestic economy as a whole, if you look at, if I then turn to slide number 8, you can see that it actually looks like the services sector is bottoming out a little bit here. And again, that suggests that we're looking at a domestic economy which is a little bit more resilient than maybe the consensus assumes a little bit. The thing is a little bit difficult because everything has to get lumped together in headline forecast in the Eurozone. But I think the services sector is still looking quite strong in the Eurozone, I'd say, from that perspective. I apologize. There's a wrong headline in this chart, so I can fix that and send out the proper one after this presentation. So what does it all mean? Well, I mean, as I've just done my like I said, I've just done my 2021 forecast, which basically means I've basically done my new outlook, and I think and what is immediately clear here, and what I'm going to do now is I'm going to invite you to step into my world for 5 minutes and assume you were forecasting the Eurozone economy. And if you do that at the moment, you have to make some pretty strong assumptions about what happens to net exports, not so much domestic demand. So if you look at domestic demand, this chart is what happens when you assume that consumer spending accelerates a little bit to about 1.5. Private investment is probably slowing now. This is my assumption, especially in the manufacturing and external sector. So I'm assuming a slowdown in net investment to about 2.5, 3 over the forecast horizon, from as high as 6 coming into this period. And then I'm assuming a gradual but fairly modest pickup in government spending. So you end up with this. You can see the profile of growth is down, but that's mainly because of carryover effect. I mean, let's call it 1.5, right? I mean, that's more or less decent. That's more or less what it is. And as far as I can see, and if you try to back out some policy assumptions based on this, just to say our policy, economic policy, both monetary and fiscal, is that going to be accommodative based on this profile or tight based on this profile? Clearly, I would say risks are tilted to the upside in terms of, I think that the policy stance is going to be accommodative based on this baseline, on the basis of this forecast. So, obviously forecasting into 2021 at this point, that's a marked game. But even with relatively benign and simple assumptions, without making any sort of wild swinging your assumption of domestic demand, this is really what I'm trying to say, you end up at about 1.5, I'd say, more or less. I mean, again, if you have some kinks in your forecast in terms of some of the components, of course you can end up differently. But I think this is where you end up, which is, and I have to say, in the Eurozone, that's pretty good. I mean, I think trend growth in the Eurozone is probably a little bit lower than 1.5. I mean, it depends a little bit. I mean, if you just look at productivity and working age population growth, obviously it's probably below 1. But if you assume that historical productivity growth is not 0, which I don't think it is, and if you assume that structural unemployment rates could fall and the labor force participation rate can still pick up a little bit over time, just to say, if you don't assume that the worst scenario about the structural picks in the Eurozone, I think you can get to a trend growth that's a little bit higher. And then, as I said, you end up with this relatively decent picture for domestic demand. The reason why I've kind of extracted the domestic demand picture is that once you then add exports, the GDP data goes wild. And this is kind of normal in the Eurozone. The Eurozone is a very open economy, so it's not like a surprise that once you start playing around with the net export data, that the GDP the numbers start to get more volatile. However, the special trick at this point is that any Eurozone economic forecaster that sits down and starts to forecast the economy based on the data such as they are now have to make an assumption about net exports turning around at some point. At least I think so, because right now net exports is basically straight down on a trend basis because it's coming from a very high level in terms of the boost in 2017 and into 2018. Now, of course, you can assume that continues, but then you basically end up with a situation in which net exports is more or less a permanent drag through the forecast horizon over the next 2 years, which I think is, I mean, it's possible, but I think that's maybe a little bit too tight. So what I'm assuming here in this forecast is I think that export growth probably picks up a little bit in the next sort of 6 to 12 months as the US and China strikes a trade deal. And then I've kind of incorporated a mild US recession because we think that the US, that the Fed will then start to raise interest rates next year as the economy improves. And then that wild jump you see at the end, that's basically just base effects in the year-over-year rate. I mean, that's basically it's just math. So if you don't believe that the Fed is going to raise interest rate next year, which I'm sure there's a lot of people that don't, then basically you just take that out, and then again you end up like I said, you end up with GDP growth in the Eurozone at about 1.3%, depending on the carryover effect. The reason that my forecast goes up a little bit towards the end of the forecast horizon at about 1.4 is because I'm assuming a very sharp rebound from a recession, which is going to be relatively mild. Now, for the record, if you run this through, you also get a technical recession in the Eurozone at some point in 2021, at the end of 2020, 2021, but it's sort of very, very sensitive in terms of what assumptions you put in. So obviously, I understand that for you as investors and traders, and you might look ahead 3 to 6 months, this is not terribly useful for you. However, I do think it's important for me, again, to underline what assumptions that I have for the economy. And if we then forget about the net export contributions, which tend to be very volatile, I mean, as far as I can see, you have a Eurozone economy that's currently growing. If we're very pessimistic, we're down at 1. But if we're a little bit more optimistic in terms of a stronger underlying trend in domestic demand, we're close to 1.5. And that's not bad in the Eurozone. That is a pace which will allow unemployment to fall, to continue to fall. It's a pace which will allow investors, this would be you, to operate in the equity market. This is to say, to do bottom-up analysis and be exposed to Eurozone equities, which I think, by the way, is an important story just to include in this this narrative that I'm telling, because I mean, I look at the same when I look at the sort of surveys and fund surveys at the moment. I mean, it seems to me that investors are still extremely negative about Eurozone equity exposure, sort of almost from a structural perspective. And I kind of understand that in terms of that there are a lot of risks, and Brexit feeds into that as well. But you really have to make some political assumptions about the sort of structural political deficiencies here, and make some quite hard ones, I think, because there's nothing really, as far as I can see, in the economic outlook which would justify that, especially not given that both fiscal and monetary policy are likely to be quite accommodative. And also, just as a final point here, I mean, it's the Eurozone now runs a current account surplus, right? So in terms of, and all the major economies have much better sort of external financing conditions now. So it's unlikely that if you saw a big blow up in the global economy, this is to say, if global excess liquidity suddenly contracted a lot, I mean, it wouldn't. I don't think it would be the Eurozone that would be hit hardest, but it would be hit for sure because it would import the weakness from abroad. But it wouldn't sort of be like ground zero, I think, for that kind of event. Anyway, slide number 11. Yeah, that's just my net trade assumptions. I mean, I've already gone through that. So that's basically the economic story, I think. And as far as I can see, compared to the consensus, that's slightly more positive. But again, as I said in the beginning, as far as I can see now, if you look at consensus forecasts for this year and next year, they're pretty much locked in at about 1%, and I think that's more or less correct. I mean, I don't want to be a hero at this point and be much offside compared to that, except that I'll say that given base effects are now very favorable for growth, if global trade just picks up a little bit on the back of some kind of easing in the tension and trade war tensions, then there's upside here. But of course, the flip side to that is that Trump might then choose to include Europe in the next trade round of trade war. So I think there are balance here, but in terms of sort of the aggregate data, that there is risks to the upside here in terms of the sort of year-over-year growth. Right. So now that allows me then to make a transition into the inflation data, which then will allow me then to hash out the ECB story a little bit more. Headline inflation in the Eurozone is completely uninteresting at the moment. I mean, you look at slide number 12, basically what's happening is that I think energy inflation is now pretty much stable at a little bit below 2%. It depends a little bit on how you look at it, because actually in energy inflation should be falling a little bit at the moment, but it seems that there's some kind of margin between oil and the energy component at the moment. So, but in any case, I think headline inflation about 1.3, 1.2%, maybe a little bit lower. And then base effect suggests that headline inflation towards the end of the year will pick up, which is basically effectively the same thing as saying that unless we assume as forecasted that oil prices are going to fall by the same amount in October, November, December as it did last year, which was a really big crash, headline inflation is going to pick up. Now, we forecasters will have to make some assumptions about that as we get closer, but at the moment, I think most people have this little jump at the end of the year to take into account that you have base effect from last year. The core rate in the Eurozone, well, it's going nowhere, is it? I mean, so this is the thing about this is mainly the issue for the ECB, right? And the issue for the ECB is that when the ECB meets in September, they'll be looking at some GDP data which probably have become worse, and the core inflation picture is probably going to be more or less the same. You're going to have core inflation at about 1.1%. You start digging into that story, and you then pretty much realize there are then two kinds of avenues you can take. You can take the avenue that, well, really core inflation in the Eurozone, the headline core, sort of the aggregate core index, is beset by a lot of sort of one-off volatility sources. So if you strip all that out and look at the so-called supercore indices, which, I mean, I don't have it here because I think the chart looks a little bit busy, but if you look at that, yeah, sure, that's going up, but it's still way off the ECB's target, which is 2% or close to 2%. And it's not really going to get there anytime soon anyway, right? So you end up in an environment where the ECB is missing its inflation target. And because it's missing its inflation target, it is kind of forced to use the same tools, or double down, as it were, almost on the same tools as it has been using up until now. So here, I think that with Lagarde coming in, there are kind of three big discussions that are going on at the moment, which are, as far as I can see. So when it comes to Lagarde, you have two overall narratives. One is that she's a candidate. She's going to continue the policy set by Mr. Draghi and the Governing Council, such as it looks now, which basically is Mr. Correa and Mr. Draghi, who's kind of like been the chief architects of the current policy framework. I completely agree with that. I mean, the markets will listen very closely to Mrs. Lagarde's comments on negative rates, right? Because that's really sort of, at the beginning of the year, I think the forecasting consensus had this notion in their assumptions that maybe the ECB could abandon negative rates but still have a very aggressive forward guidance after that. That idea has been very thoroughly killed by Mr. Draghi this year. So, and I expect Mrs. Lagarde to kind of continue that, but you can be 100% sure that that markets will listen very closely to her comments. And that's also why, and I think that there's also been a lot of discussion this about, Mrs. Lagarde, inexperience or whatever as a policymaker. And I pivoted on that story as well when I wrote about her point, which is not to say that she's obviously not competent, but the point is simply that she is inheriting a quite technical policy framework here, which is very sensitive to the communication that she as a president is going to give. I think that's the best way for me to convey it to you as investors, which is not to say that she's not up for the job as it is. I'm sure she is, but there's going to be it's this very intricate kind of forward guidance the ECB has laid out here is very sensitive in terms of how it incorporates market expectations and market reactions. So again, there is scope for volatility when she starts to speak, but also because I'm not 100% sure she's just going to be sort of this idea of a lame duck president who just outsources all the technical stuff to someone else. No, I don't think so. And I'm sure she has her own view on these things. So yeah, so there could be volatility, right at the beginning, but at the moment, but I think she's going to continue the same tools, which is forward guidance and the commitment to use more QE if needed. And just for the record here, as I'm talking about this, my formal forecast is a deposit rate cut of 10 basis points to minus 0.5 in September and a tiered deposit rate. I don't think they'll restart QE in September. Whether they do 10 basis point or 20 basis point, I mean, this is not a hill that I'm willing to die on. I right now, I think Euribor are pricing kind of like in between. And if I think that if we come into the September meeting with markets looking for 20 basis points to say market actually pricing 20 basis points, I'm happy to give them that they might do that, but I don't think they restart QE. And the tiered deposit rate is going to be horribly complicated, but I think that they will try to do it in order to kind of signal that, the back and forth. It's a signal that they're trying to mitigate the negative impact of negative interest rates on the banking sector. Again, QE. Again, I think the ECB is just going to continue to emphasize that they will that they stand ready to use QE, but I think it would take a significant further deterioration in the external environment, say basically the trade wars, for that to come into play. The debate, I mean, the thing is, forecasters, the latest I've seen is that some forecasters are now looking for them to include bank credit potentially in a new QE program. I mean, all these things are in play, but just to say that they're not going to run out of sovereign bonds, right? They're going to, if they wanted to do QE, they could buy sovereign bonds because they changed the rules. So that I think is the first point to make, and they'd also include corporate bonds again. So whether they'd go for bank credit or even equities, the point about these two markets is that bank credit is a debt market. I mean, you need issuance, and banks are not allowed to lever up by bank credit. Allowed. I mean, they're not in a position to do so. So, you'd be buying in a more or less debt market, which is not ideal. And in terms of equities, I mean, look, don't get me wrong on this. If they start buying equities, the Eurozone equity markets are going to go absolutely nuts, right? It's going to go up straight up. But from an economic point of view, the argument is quite poor because Eurozone households don't own equities, and you're just going to make a lot of foreign investors quite rich. And so the economic argument to go that route is not hugely convincing in my view. But obviously that hasn't stopped central banks before. But it's just to say that I think QE, the idea of them restarting QE is premature at this point. So looking ahead to September, and then cut the deposit rate next week, and just to make a note of that, it's all going to be about the first initial press release and the change in forward guidance. Right now, the forward guidance, it precludes the idea that rates can go lower. They have to change that. I mean, if they don't change that, I'm like, that would be a rookie mistake. I mean, in the sense that they could still cut rates, of course, but if they don't send the signal next week that rates can go lower, that would be a big shock to me, given where market expectations is, where forecasters are, what they've been saying. That would be a big surprise. So actually, I think that all the excitement next week is going to be in that first flash that comes out at like 12:45, whenever, and we get that initial press release, which has the formal language and the forward guidance. So that's how I intend to play it, as it were, next week in terms of my preview. If you move forward, I mean, again, slide number 14. It's basically that's my inflation forecast, and I know these things. I mean, it's just a straight line going up. But I think the main point about this is basically the 2021. I mean, who knows, right? But actually, I expect the core rate to be locked at about 1.2, 1.3% in the next 12 months, which again tells us, if I'm right, that then tells us something about what the ECB faces, namely that Mrs. Lagarde is going to come in. The actual core rate is going to bump up and down on a monthly basis, but it's probably going to remain more or less trendless, right? And this also means that I'm pretty much 1 year behind the ECB in terms of their official forecast. In terms, I think they're still being slightly too optimistic in terms of the average core rates over their horizon. So, I mean, again, what does a central bank do that can't reach its inflation target? Well, get stuck at the zero bound. You try to talk up inflation. Maybe if the economy then, if I'm wrong on the economy and that deteriorates, QE is back in play. But it's very accommodative monetary policy. It's very accommodative monetary policy. And I say this with a fair amount of certainty, because the main problem for the ECB is really, if you go to maybe we can just move faster between these two charts. But if you look at slide 15, services inflation, that's probably going up, and I can see service inflation going to, I mean, if not 2%, then 1.7, 1.8 over in the next 12 to 18 months. But I mean, non-energy goods inflation not going anywhere, right? 0.2%. That number actually was revised a little bit higher today, 0.3, just to make a mental note of that. But this is basically what you're looking at here is 40% of the core, which is at 0.2, 0.3%, and you want the core to get to 2%. Ain't happening. I'm sorry, it's just not happening. And so then I'll leave it to the POP to discuss, to the people at the POP to discuss whether the ECB's inflation target is too high or too low. When I look at the debate at the moment among monetary policymakers, it suggests that we're still in an environment where most people are talking about maybe they should raise the inflation target, because that would again lend more credibility to send a signal to the markets that they would be more aggressive in reaching that target. I mean, all I can say is that good luck, because you're not getting there. So, but again, for US investors, this is just an academic discussion. What you need to know is that the ECB is locked into a quite accommodative stance given its mandate. So that's all basically we need to know at this point. And the only sort of the flip side to that argument is that if any ECB official or EU official came out and start talking about a change in the ECB mandate in any kind of way, either up or down, obviously that would be a massive market moving event, but I don't think there's any risk of that. If we then turn to fiscal policy, I'm going to start that discussion by looking at the labor market, because if you look at the labor market, I mean, it is quite extraordinary actually that we are in an environment now where we're talking about downside risk to inflation, downside risk to growth, and therefore the ECB is going to ease further. This is kind of like the main story, right? Even though my economic story is slightly more positive than that sort of. But unemployment is basically at the same level it was in 2007, 2006, now before the financial crisis, right? So this is to me, this is an extraordinary debate until you then realize that the goalposts have now been moved so far in terms of the sort of Phillips curve, Nairo discussion that, I mean, I could basically tell you that structural unemployment in the Eurozone is about 7.5, 7, and we're there now, and now inflation is going to start to pick up. But nobody would believe me, and actually the data also shows that the Phillips curve, for whatever reason, is much flatter than it used to be. So in this environment, the story very quickly becomes, well, unemployment is still quite low. We need to keep the recovery going so that the unemployment can fall further. And that brings in fiscal policy, because if you look at the next slide, the rate of improvement in the labor market is now slowing, which is completely natural given that GDP growth has basically have more than halved in the last 12 months, right? So I think that, we used to, if you look at this expansion, such as it came into being in kind of 2015, you had employment growth at 1.5 to 2%. Now I think employment growth is slowing to less than 1, perhaps even lower than that. And that's going to that eventually that'll feed through to fiscal policymakers or politicians, that they're going to realize that the labor market is not improving as fast as it used to do. If you go if you go a little bit into the detail, you'll see that, not surprisingly, the main sources of downside risk is in Germany. If you look at slide number 19, and if you look at Italy, slide number 20, right, which is the two economies, surprise, surprise, where growth has slowed the most. So I am not 100% sure that the actual unemployment rate in Germany is going to increase, because employment growth is still quite strong. But there's certainly a risk that the headline unemployment rate, just today, the monthly claim stage in Germany, is going to tick up a little bit in the next 6 to 12 months, 6 to 9 months. And, that's a major story given the fiscal policy stance in Germany, because I don't think Germany is going to suddenly go on a spending spree, but a turn in the labor market, plus the fact that the political situation is now changing a little bit in Germany, insofar as that Merkel is on the way out and other politicians are on the way in, and we have a change of guard in the EU as well. I'm starting to warm to the idea of a slightly less, should we say, hawkish German fiscal policy, or a more accommodative German fiscal policy, simply because the economy is going to need it. I mean, full year growth this year is going to be 0.5. That's quite low. It's probably going to pick up to about 1 next year, but it's not going to be very impressive. And if Germany starts to spend more, then suddenly, we're in business, because then everybody can spend more. And in any case, the Commission is not really going to throw the book at anyone. The Italian situation is a little bit different, because the thing about Italy is that this year's budget deficit projections, they've already been shot to pieces, because growth is 0 this year. So that means that even if the Italian labor market rolls over, which I think it will, there's not that much room, but still there is more room that there would have been if you had a sort of a very sort of tight fisted commission in place, which you don't. So again, as I said earlier in this presentation, this is a super tanker, but it's moving, and it's moving slowly. And I think that that if you combine that with what everybody kind of expects, and I think this is kind of like, it goes without saying that the monetary policy. The monetary policy backdrop is going to be accommodative as well. Well, you're going to end up with more accommodative fiscal policy, still accommodative monetary policy. All the cynical and all the cynical supply side economists will say, "Oh, you be careful about the inflation; it's going to pick up," but it's probably not going to pick up, is it? I mean, at least not in the short run, right? So we're dare I say it, Goldilocks or something like that. I mean, but it's not really Goldilocks, right? Because growth has come down, so it's not like you have this strong growth and low inflation, but it's an environment which allows policymakers to pretty much to run a little bit looser policy, and more importantly, the political and economic consensus is moving towards that as well, right? Leaving basically Germany as kind of like the odd man out, looking a little bit odd with its budget surplus and what exactly they're doing, and growth is falling. So, I mean, again, I think it'd be odd not to expect some kind of shift here. The final 2 slides, I mean, and this is just again to show. It's basically, it goes back to the QE discussion, but I mean, I think it's interesting also to note that the latest data suggests that net Bund issuance is starting to pick up a little bit, which could be a sign that tax revenue is starting to come down because growth is slowing, and yeah, that could be a change as well, a little bit. I think that could potentially be a change for the Bund market as well. In terms of if the idea of Bund issuance picks up, I think that if you look at at Eurozone bond yields at the moment, if you look at the Eurozone bond market at the moment, I mean, this is not a story about the level of bond yields. This is a story about the pricing in of extremely low interest rate in the Eurozone for an extremely long period of time. And it's a story about the curve, right? That the US curve is very flat. The Eurozone curve is still relatively steep, even though it's negative, and therefore the roll and carry, currency adjusted returns for a US investor in Europe is actually quite strong, even with negative yields. And that's, as far as I can see, that's the way the markets have been trading the Eurozone government bond market since, well, this year effectively. And so there's not really a level story there. And I think that we're going to continue to see that. I mean, the most juicy trade in Europe from that perspective, obviously, is BTPs, says the Economist, after 200 basis points. But I mean, I actually still think that can compress more, because in an environment where the Italian government is not, and I just emphasize, is not kind of threatening to leave the Eurozone, then, BTP should trade as sovereign debt, and sovereign debt, roll and carry. I mean, the Italian curve is still what? I mean, 150 basis points spread between the 10-year and the 2-year. So there's a lot of juice there for banks in particular, financial institutions in Italy, but also investors in general. So I think that trade probably still has legs, especially because it seems to me that if you look at global monetary policy, and I'm including obviously the ECB here, but also the Fed, is that, the central banks, they gave at the start of the year, both the ECB and the Fed to some extent, not coordinated, but almost at the same time, they gave markets a finger, and the markets just took away the whole arm, and there's just no way that they can't deliver something yet, even though, I look at, the Eurozone economy and even the US economy and say, what's the point in moving into necessarily an easing cycle here? That doesn't seem a lot of sense here, but, we're way past that argument now. This is happening, it's coming. And markets are reflecting that. So I think from the ECB's perspective, I think the deposit rate cut to minus 0.4 is to minus 0.5 is the right play. The final chart is about corporate bonds, and this is just for me to show that net issuance have gone down actually, but I think net issuance will pick up again if you then had a QE announcement again. The market kind of responds to the ECB here, and I would do so again. So, and I fully expect the ECB to include corporate bonds if you had a new corporate QE program. So that was all the charts. There's one kind of story which I've omitted here because it's new, and it basically relates to the euro and the dollar, and this story which has surfaced in the last couple of days, mainly driven by FX sell side notes. This idea that that the US could consider currency intervention, and that this idea that currency wars could heat up, which obviously, by the way, would be bad for asset markets. Now, this is mainly a US story, but all I can say about what I will say from the ECB's perspective is that the rule of thumb is very simple in the Eurozone, right? The rule of thumb is that if between forecasts, this is to say, for example, between June and September in the Eurozone, if the euro goes up by 10 to 15 percentage point, 10 to 15%, if the euro appreciates relatively rapidly between ECB forecasts, the staff will downgrade the core inflation forecast by about 0.1 to 0.2 percentage points. And that in turn historically has been, not always, but that has sometimes been catalysts for policy moves, or help to nudge the ECB into a direction of in this case, easing monetary policy. Right? So I have no doubt that if the market starts to push the dollar down on a hunch that some of this is happening, or if Mnuchin and Trump, or both of them, or Trump's Twitter feed suddenly lights up again, that'll just feed dovish into the ECB's reaction function. That's as far as I can. That's as far as I'll take this story for now. All the other stuff about a new Platts Accord and everything, that's pure speculation at this point. And in any case, like I've said before, this is also because this is mainly a result of dysfunctional U.S. economic policies, in the sense that Trump is winning the trade wars, but he's losing the currency wars, and now he wants to win both at the same time. So which is very difficult, because we have free capital mobility, and if the dollar uses, if the U.S. uses its might to punch and push around its main trading partners in terms of raising tariffs on the surplus economies, well, I mean, I just think that the market will trade the dollar higher. Right? This is what we've seen so far. So this is a very sort of awkward situation from an economic perspective. But all I'll say is that for you as investors, if you want to compartmentalize the Eurozone story here in this sort of very speculative narrative which is starting to emerge, it's very simple. 10 to 15% increase in euro dollar over a short space of time, just to say a noticeable appreciation, feeds into the reaction function in a dovish fashion via a downgrade in the core inflation. That's pretty much what you need to know, and that's how I would play it as well as a forecaster until I was told otherwise. So in summary, we have Q2 GDP headlines, which effectively is the data that's coming out at the moment. Probably would be grim, especially the German one. I think the German one, we could have a GDP contraction in Germany, depending a little bit of what happens to the June data. But leading indicators suggest that some of the underlying trend here is stabilizing. We're still bifurcated the economy between weak manufacturing and decent consumer spending. The ECB, yeah, well, I mean, further easing is coming. I'd be very surprised if they did not prepare markets for that next week. And I re-emphasize, next week, I'll be listening to the press conference and I'll do notes, and by all means you should as well. But I think all the action will be in the first press release that comes out, where I think they'll change the forward guidance, and that's it. I think from then on, I think the excitement will be downhill. So that, I suppose that's good news. But I mean, in terms of, you don't have to spend time in front of listening to Mr. Draghi. But I think that's going to be the story for next week. I think Mrs. Lagarde will be a dovish ECB president, but she doesn't have any control of fiscal policy. I mentioned that because there's another idea, is that she would be some kind of fiscal Trojan horse that would kind of come in and try to use all her connections sort of to finance ministers to get sort of a more fiscal stance that she could then support as an ECB president. I think that's way premature to assume anything of that. I mean, history suggests that if you're trying to influence fiscal policy from the chair in Frankfurt as an ECB president, good luck, right? I mean, this is very difficult to get a voice, I think, in terms of actual policy making into the government, into the council. As an ECB president, they'll listen to you, of course, like they listen to Draghi. But at the end of the day, I think there's going to be, a split between those two. Although, I mean, I'm sure she'll argue, just as Draghi has done, for looser fiscal policy. And finally, I think one of the big stories in the second half of this year is going to be the German labor market, which is now deteriorating, and that ought to change the policy on fiscal spending, which, again, and I've had conversations with clients about this quite a lot. And by the way, I haven't forgot about the Commission President Rel just mentioned to us at the very end in terms of the sort of politics around that and economics around that. But just to finish in Germany, the signal itself here would be a market movement event, right? So this is why I mentioned it, in the sense that, if Germany comes out and says something about building of infrastructure and bridges or whatever in 2020, 2021, I mean, markets won't bat an eyelid. But on this occasion, I think they would. I think that would be a big signal to markets, and I think there would be a market movement event. And that's why I'm mentioning it. That's why I mentioned it as a specific point, because I think it would be. So, and then finally, and it's really difficult to put a chart on that, but of course we had Ursula von der Leyen, who was approved, and so she's going to step in as the new commissioner. She's a card-carrying European, and in some sense, she's very pro-Europe, which she's supposed to be. She's, in terms of the sort of the main issue, she seems to be relatively dovish on Brexit as well. When I say relatively dovish, she seems to be open to an extension, which is, I suppose, good news from that perspective, in the sense that that probably takes a little bit of the no deal risk away, even though this is going to be a UK story in the end. And finally, a story which I've had conversations with readers about is this whole idea about competition, and the idea that the new commission is going to be sort of a little bit more pro-European. This is to say, a little bit more pro-European champion, like in its competition policy, which is to say, you have the Commission today, Margrethe Vestager coming out, and France coming out with digital taxes, mainly on US tech companies, and then that's going to continue. But then on the other hand, on the other side, you might allow, I mean, just to take some examples, you might allow your European telecoms company to merge, even though that means that one company will gain more market power, because you need European champions to compete against Huawei and compete against some of the big US companies. It's very difficult, of course, to say where this goes, but I think it's fair to say that the tide is moving towards sort of a more, and I'm going to use a French word here, because this is getting the French narrative, more dirigiste. This is the idea that you have this idea that the Commission could, or the EU could, kind of support the creation of Eurozone champions, or perhaps not work against them. I'm warming to that idea, but we don't have anything. It's very difficult because we don't have anything concrete yet, right? But I do think that there's a push towards that. And I think, again, the big regulated sectors such as utilities, telecoms, some of the big industrials as well, it's going to be the main litmus test for that. And let's see, whether some of them will have the wherewithal to try to go for a merger, and we'll see how the commission plays out. But maybe a little bit more sort of friendly environment for companies that are exposed to Europe and to European growth story, and sort of to a European regulatory story. Whereas, maybe if you're Google or you're Amazon and you're trying to sell into Europe, maybe you're going to have a tougher time now, because the commission is going to be on your case. That type of, I would say, sort of economic nationalism a little bit, also to some extent to combat the fact that that's what we're seeing from Trump. All this is speculation, but it would make sense if the shift would happen now as the new commission comes in. All right, I think I'll leave it there. If you have any questions, let me see whether I have any questions. You should be able to type questions into the chat. I don't see any questions right at this point in time. The layout on this platform has also been changed a little bit, so maybe it's some of you are struggling a little bit to find your way around. I was. And so I don't see any questions at the moment. So I think I've already spent about an hour of your time. So I think I'm just going to end it here. As I said, there'll be a replay on this. And if you have any questions, follow-up questions, please just call me or write me an email, and we'll take it from there. Thank you very much again for calling in and taking the time. I appreciate it, and I hope to speak to you soon.